We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Oliver from Momentum Structural Analysis. Michael, thanks for joining me today. How are you?
Good to be here, Tom.
Excellent to have you. And Michael, I think this is a perfect time to be kind of chatting again. You know, as we are nearing the end of summer here, seasonality seems to come into view, as well as historical crashes for the equity markets. So what are some of the waves that are maybe hitting the stock market coming into September and October here?
Well, we, of course, look at technicals. Yes, I'm fully aware of the fundamentals, although I try to avoid being too aware of them because that influences me, and I want to focus on technicals. And when I say technicals, I mean momentum technicals primarily, not price. Price is often illusory. Okay. Anyway, we think the stock market, U.S. stock market, the upside is not to be trusted. Enough damage has been done starting early this year into the April drop to momentum factors, long-term momentum factors, that argues, okay, you're derailed. And yeah, we came up and made a new high, marginal, single percentages. And we're sort of wobbling around up here now for about 4 weeks, by the way. And we think there's enough near-term technical evidence to argue that the S&P and NASDAQ, two of the indexes that did make new highs, could slip back below the highs they saw in January. In which case, the assumption that, that was a breakout, suddenly, was it a breakout or not? And to go to a price pattern, which few people remember or like to talk about, is Edwards and McGee in 1958 wrote a book called Technical Analysis of Stock Market. Mm-hmm. And it's a 400-page monster, thin pages with fine ink. Okay. And they had so many chart patterns in there, a price chart. Mm-hmm. And one of the ones they had for a topping pattern is called a broadening top. And that's where you, instead of a tightening triangle type pattern, which everybody knows about, a breakout of a triangle, it's the opposite, where you're narrow on the left side going back and you widen over time, where your market makes 3 consecutive higher highs and 2 lower lows, 5, 4, 3, 2, 1. And it's a broadening top. And it's that third new high. Now, remember, we made one in the summer last year, then we made one early this year, followed by a big drop, and then we're making a third new high. If you fail from that third new high, start to pay attention what Edwards and McGee defined in terms of price. Momentum says that's highly likely, in which case the bubble is topping. And we are a bubble index, not true with the whole world, by the way, but definitely the U.S. And when it breaks, it should be quite painful because it's the oldest bull market in history. 15 years of upside, 19 to 20-fold move in the NASDAQ 100. No bull market in U.S. history matches that. And it's, monetary factors, M2, look at an M2 chart, look at Fed funds rate, stuff like that. It's like drugs into your arm. Mm-hmm. And so it looks like it's topping from our perspective. Momentum perspective says, no, it's not to be trusted. The issue now is to prove it to the price guys. And I think the first thing you do in that regard is slip back below that January high, which isn't all that far below our feet right now, actually, in terms of percentage. But there's other factors we're watching too. We can get into those that are not the prime. Everybody's looking at AI. Well, yeah, true. That's the leader, and it's likely when we go down to be a leader on the downside, percent-wise. But there's other factors out there that are likely to kick the market in the gut that come from the sidelines that people aren't especially focused on.
Michael, before we get to those other factors that could kick the market in the gut, how do you you and I have spoken before about this idea of a long grinding type of bear market. Are you still envisioning something like that? Or is it possible that we see something, far more dramatic considering the age and the breadth or lack of breadth in this bull market? in equities
could
in
be.
particular.
In other words, do we get a crash event? Okay. And the odds are no, even though it's a bubble. That crashes are rare in a bear market. For example, in 29, it started with a crash, but then it came all the way back, halfway back to the high in early 1930. And then the real bear market started from 30 to 32, where we dropped like 80% in the Dow. But there was no crash in that process. It was just laborious, grinding bloodbath.
And what do you, sorry, Michael, what are you defining as a crash scenario?
Crash
is that, 20% in a day, or?
No, it's usually 30 to 35 within a week or two.
Okay.
You go back and look at the 29 crash, it meets those definitions. And that was the onset of a new bear market. There was no crash in the 2000 to 2002 bear market, the dot-com top. There was no event where there was 35% overnight type thing. It was more arduous. 2007 to 9, we did have a crash event, but it occurred a year after the high. You were already well into the depths of a bear market. It wasn't like right off the high. Before you had that October event in 2008. And that wasn't even the low. He went on down to March 2009. But it's kind of rare to find a crash. And I can't deny it could happen, but I tend to think, looking at the momentum structural factors of the stock market, that it's going down, but probably not with the 30 to 35% initial jolt. Okay. More likely painful, but not sudden. Okay, you get the point. The April event, for example, the January through April drop that we just experienced was only net total about 20%. And much of that occurring in March and April. So it doesn't fit crash dimensions. And of course, during that time, what did gold do? Vertical. Okay, same time. There are some markets out there that you got to watch for the potential of something you might border on a crash event. Right now, for example, we're going to put out a report in the next week or so on the banks, because during that January to April drop in the S&P and the NASDAQ, when you look at the long-term momentum of the banks, like you can almost throw a dart at any of the top 6 or 7 banks, they all have the same quarterly momentum look. Namely, they have a floor that's been used, and actually that April break, though intra-month it sort of dropped below it, it didn't really close below it, and therefore that floor still exists. The problem is it's been used too many times. And whenever you build you can't see it on a price chart. Price chart, you have an ascending pattern. But on momentum, you have a line that a guy with a crayon could draw, and you say, oh gosh, again. And that's what I'm talking about. That exists in the banking sector. And of course, we all know that while nobody's paying attention to that right now, if all of a sudden you get a headline out of the financial markets, and by the way, Visa and MasterCard, which is kind of interesting because we hear all the stories about consumer credit. It's maxed out. People are defaulting. They're way late on their payments. And yet when you look at Visa and MasterCard, the price charts seem to be laughing at that notion. The momentum charts aren't. They're saying, hey, you built a floor under you that if you break, you're going to implode. Okay. That's a headline event that nobody's anticipating. There's some others as well, but I don't expect a crash. Most of the bear markets, whether they're 50% or 80%, like 2000, 2002 is 50% for S&P, 82% for the NASDAQ. Still no crash. They last about 2.5 years or so. So usually when they get going, they're at least 2 years, maybe get into 3 before they finally get their thing done. And then the question is what percent? Well, even in that bear market, it was a sharp difference between S&P and NASDAQ. So I'm not going to forecast once the bear starts, where are we going? I'm just going to say, well, the norm is you go down hard for a couple of years. And that will be a very upsetting factor. If you recall what 2008 and 9, not 7, but 8 and 9 especially, that's when the headline events started sparking. Oh, Lehman Brothers went under. Golly, how'd that happen? Et cetera, et cetera. We need to help support GM so they don't collapse. So the government gave money, Those kind of events will likely occur, meaning the guy in the street who may not even be in the stock market or he's in the market and his 401k he looks at, and it's the only thing he's smiling about right now. Absolutely the only thing. His wife's complaining about the consumer costs. And wait till his gasoline prices go back up, which is something we're forecasting as well. But go ahead.
Sorry, Michael, to that point, I heard, I think it was Dave Collum the other day said, this type of attitude within the markets isn't necessarily indicative of a major top. Those euphoric types of tops that we've had in the past where everybody thought they were going to be millionaires, where everybody was just super excited about the markets. There's, I think, very few people that have that kind of optimism at this point.
Well, maybe among analysts, but from what I hear from some of the major brokerage firms, the percentage of their investors that are highly leveraged in the stock market has never been so high. And the percent of their leverage has never been so high.
But I think this also applies to Main Street, right?
Yeah, that's what I mean. They're not just the super wealthy, but the average guy, So there is some evidence that the public is frothy. We know one arena they're really frothy about, and that's Bitcoin. And I think that could be a major ambush. But no, I see enough frothiness, but I don't know how to measure that. There's a lot of people that do, and from what I hear, it is very hot. Okay. Anyway, but from our momentum technicals, I see a major top in the US bubble. It's been developing actually for a year now, with that broadening pattern I described. And I see within the market certain components that are too critical to ignore and yet aren't being talked about a lot. Again, financial arena, credit cards, also many of the banks didn't suffer what S&P suffered in terms of momentum breakage back in April. They set that structure where if you go down again, and we get it 5 weeks from now, we're in a new quarter. So all of our numbers that are trigger levels that break it will jump up. And it's not far below the feet where the price action is right now in many of the banks, and especially Visa and MasterCard. And those would be, oh my God, how did that happen? Events. And that's quite often, as you recall, you go back to 8 and 9, for example, it was these sideline events that suddenly, what was that? It's not the things everybody's looking at. And that's what creates emotion. It's when something happens that you weren't looking at and you feel like, gosh, you're out of control, and panic sets in. That's when emotion comes into play. And I think it's pretty much a rapid switch event when some of these things start to happen, where you go suddenly from euphoria to desperation or uncertainty.
Right. Well, let's go. I just put up the Bitcoin chart that you sent me here just earlier. Yeah. Since we're kind of on that subject, how does this, we can't see this, as you said, from price action, but how is this really showing you that there is a major risk within the Bitcoin?
Well, look at the two sets of charts are Bitcoin and its quarterly momentum. And the bottom right is the S&P 500 back at the 87 top and its quarterly momentum. Okay. What you have on both price charts is this lovely layered advance where you have congestion zones, meaning distribution. There's sellers that come in at certain levels, like on Bitcoin, you could see there was a shelf at about 75,000. It persisted for 3/4 of a year. And then when you pull back, you sat on it again, back early this year and held it, April low, coincident with the stock market, by the way. Then you go up and make a new high above another distribution zone. If you'll notice there, July and August, those are the last two bars there. These are monthly bars. If you go back to the left, you'll see late last year and again in June and April, May and June, there was a level there at about 110,000 where the market was having problems. Also back in late 2024, there was sellers at 110,000. So we're now above there. So it looks like this process just goes on forever and ever. But when you drop down to the quarterly momentum chart, what you see is the momentum strength really ran out back, 2 years ago when you got up to about 75,000. Then when you came up and made that new high at 110,000 late last year, notice the momentum peak was only halfway back to that high. So you were losing momentum. Now, that's just something to look at. It's not an actionable trigger. It's just indicating I'm not as strong as you think I am.
Mhm.
But look at the floor on that momentum action. 3 separate pullbacks in this several-year bull trend that held without closing below, traded down to maybe marginally below the 0 line, meaning the 3/4 moving average. That average in 5 weeks is going to jump up to about 101 to 102,000, which is to say about 9% below today's traded low.
Mhm.
I would suggest to price guys that even getting back below 110,000 now, which is to say, take out this month and last month's lows and get back below those highs that occurred late last year and early this year, that indicates, oops, something's wrong. That price breakout didn't hold. Momentum, you get down to 101, 102, which on that price chart doesn't look too dangerous. If you look at where that is on the action, you'll be hitting that quarterly structure again. And I'll tell you, it is not going to hold a fourth time. Go to the S&P now. If you look at the price chart back in 86, 87, 85 through 87, it was also a multi-layered advance with distribution zones, then a surge breakout, and then another distribution zone, and then another surge. It was like, oh, it's going to go on forever this way, right? Okay. Problem was that once you made that summer high, August, September, it was August actually was the high in 87, you oozed back down just a bit in September. And when you opened October, that big, ugly, dark, that big bar there, when you came down to the 3/4 average at the price of 300 on the top chart, which is to say you got back below the highs that had preceded back earlier in 87. But momentum for the fourth time was hitting that 0 line, a structure that had been used just too many times. So I happened to catch this, and so did I got my customers in it. It was a futures broker then. I didn't catch it in a big way, but I caught it with puts. And the reason I did is that bottom chart. You had a floor from hell. And when you broke that floor, you went to hell. And it was a crash event, 35% in about a week. Okay. Nobody expected that. It happened because momentum says, hey, you're out of gas. You've used it too many times. This floor does not going to hold forever. And it didn't. And it was an ambush. And in this case, it wasn't the onset of a bear market. It was just a crash. In fact, the low it made the next few months was a pullback low, annual momentum, and it held up during that time. But the point being, this event, we have the same exact structure now with Bitcoin, and nobody's aware of it. All they're aware of is the giddiness of yet another new high.
The giddiness and the frothiness. But
yeah,
Michael, how you're looking at this as well as the correlation to the NASDAQ, and that really these like really highly risk on assets here.
Yes.
Does that also kind of come into your thinking of how you're
it's an interesting point, because Bitcoin is what? It's an alternative money unit, right? Okay. It's supposed to be not government controlled. Well, the government's getting involved in it pretty big. Okay. Anyway, decade ago, Bitcoin, what it did, it could have big drops and it didn't really impact too much else, which didn't cause the stock market to go down or anything. But right now, Bitcoin is so deeply embedded. So many companies are deeply embedded in Bitcoin, not just speculators, but they've got lots of money piled into this category with a sense of comfort. So that if Bitcoin drops now, especially in the manner I describe here, it's going to financially ambush many that aren't, years ago weren't connected to Bitcoin, wouldn't have mattered to them. And you're right, when you overlay, and we don't see it here, but you can overlay a Bitcoin monthly chart with a NASDAQ 100 monthly chart. And for the last few years, they're a virtual overlay, almost month by month. Well, you can see here, we dropped into April, after making a high win, Jan, Feb, March, April, okay, just like the stock market. And then we turned violently and did what? Made a new high, marginal, but new high, just like NASDAQ 100. Okay, so it's behaving exactly the same as the NASDAQ 100. Even this month, which is sort of a, well, what are we doing here? We're really not gaining much ground. The month's almost over and we're just hemming and hawing. Anyway, this is an area that we're watching, along with, I mentioned, Visa, MasterCard, and some banks. Watch Bitcoin, because it'll have wave effects. And again, even if you're not in Bitcoin, it's the sense of, gosh, I don't know what's going on. Mm-hmm. And that creates emotion.
Well, and especially considering how, tied into the financial system it's becoming, the idea of the more treasury demand coming from stable coins, more demand overall based on this asset. Is it possible that they see this as very, strategic and as a major part of the entire financial system, and that if that starts to falter, that really undermines the entire thesis? And so it will be strategically protected.
And there's that ongoing debate, gold or Bitcoin, as the quote alternative money. And we argue that gold is ongoing. It's not near its top in terms of price. Its potential in the upside is massive. Also, MSA argues that when you do reach a high in the next year or so, it's likely not to end up with a bear market on the other side. It's likely instead you'll find monetary metals have become institutionalized again as money, as this country, then that country, then that country suddenly say, hey, this hasn't been working. And what causes them to rethink? Pain, public pain, academics who begin to doubt, et cetera, et cetera. And you get those kind of changes. But gold is going to definitely outpace Bitcoin. And I think it could be a sudden awareness of that notion if Bitcoin does what I'm arguing it's likely to do, which is implode. All of a sudden, those who thought, Bitcoin's the place to be, they'll be washed, total doubt at that point. And I think that'll also help gold and silver, because then that money that was going into the computer monitored money units, think about that. They're not very private, okay? Will then rush over into the only other alternative.
Well, it's interesting how you phrase that. I recently did an interview with Willem Middelkoop, and he was talking about the weaponization of the dollar has resulted in the weaponization by other entities of gold. I think that's a really nice way to put it, right?
Yeah, it's a factor. I think still the real driver of gold over time, it's been money for 3,000 years. Okay, silver's been money too, also, backed by governments. By the way, Florida, Texas, and a whole bunch of other states have now legalized gold and silver as legal tender. Okay, a hell of a statement. That's like a rebellion. Hey, Fed, your money's not the monopoly money anymore. Okay. But the real driver of gold is simply the ongoing degradation of fiat money units. In other words, look at an M2 chart, go back 50 years, just this explosive volcano of upward curvature. Okay. Well, that's why when your granddad built a house, it was $4,500. Now it's $450,000. Okay. It's a degradation of the money unit. And gold simply reflects that. And there's a point at which finally the world will be smacked in the face, here, there, and finally everywhere. We need to get stability. And I think that's the real ongoing driver. Yes, what Fed does this time around, or what this happens over here, those are factors. But ongoing, that's really the driving force. It's an ongoing trend. And yes, gold will sometimes underperform that trend and then outperform that degradation trend. Right now, it's headed into an outperform probably, where its upward curvature is even more than the money supply growth. It's catching up, So anyway, I think that's where we are. And these other events we've been talking about, let's say a breakdown in the stock market bubble, we know what the central bank and the central government will do in those type of situations. We know what they've done in the past. Does it work? No, it never works. Stock market still implodes. They print money. They lower rates to nothing. It still goes down. And what's the beneficiary? Gold, silver.
The measuring stick.
Yeah, the real monies. Yeah.
Mhm. Michael, you mentioned the Fed there. What happens to the dollar if the Fed drops rates by 50 basis points in September here? And that's,
Well,
by the way, something that you called in the first week of August as well.
well, Powell surrendered the other day. Okay, we all know that. Okay, that was basically a surrender speech. Also, he was being crowded by enough other voices on the Fed that was saying, there were two Fed governors. Now there's more that saying, no, we need rate cuts. So he'll look kind of awkward if he found that half the Fed governors wanted a rate cut and he was still standing strong, because then it would look overtly political.
Mm-hmm. Fair.
So anyway, so he's now succumbed and he's saying, yeah, we're going to put our foot on the pedal again. Okay. But they got other tools as well. It's not merely interest rates, the artificial pricing of monopoly money. They've got other things, their balance sheet, so forth. And believe me, if some of these events start to unfold, these accidents from the side, like this bank has a headline, Bitcoin crashes. Oh my God, what are the wave effects? What they do will be even more exaggerated than what it was in 2007 to 9. Remember, they finally came in with QEs, adopted from the Japanese. I think it was after that October event in 2008. Finally, Bernanke said, okay, we got to do QEs. Did it help? No, we went down for another 6 months to the bear low. So it didn't help. What happened? Gold immediately turned and made a new high. Okay. So I think we're sitting on that type of event where suddenly things snap instead of incremental. And I don't mean have to crash. Now, Bitcoin could be an exception and maybe some banks, but that's when the central banks go berserk. And in this case, we have a president who, rather than standing back from the events, from the policy, is a full participant in wanting, free money. Mm-hmm. So it'll be not just the central bank, but the central government wanting to push the throttle down. So that could be quite exciting, and you just got to be on the right side of these events to not be fretting about it. Enjoy it. Mm-hmm. Okay.
You also mentioned earlier that you don't see a big crash likely in gold alongside the stock markets. Why is that, Michael? And
in 2008, there was that event. And that's one of very few events in the history of gold and the stock market relationship where there was a bad month or a bad 6 weeks where gold actually went down with the stock market. And it did. But at that point in time, gold had already had a massive advance during that first year of the stock market bear market. Stocks have been going down from October 2007 to early October 8, and then they had that crash event. A full year off the high and a big percent off the high. Gold was going up the whole time. It's only in that month or August, September, then October that gold participated. But for gold, it was a needed correction. Our technical showed that gold at that point said, hey, I need to correct. It used that as an excuse. And then when the Fed came in with QEs after that October stock market event, stock market continued down into March, a good percent further, the March of 2009. Gold immediately turned and was back to its high within months, while the stock market continued down. So with the exception of that September-October event, if you looked at the bigger trend of gold from 2007 on to 2011, actually, gold was just continuing up. It took until 2013 for the S&P to finally get back up to the high it saw in 2007. Look what happened to gold during those years. Huge up. Okay, so I think that scary notion that, oh my God, gold's going to collapse, the miners are going to collapse because of the stock market. If the stock market crashes, and that's a big if, I'm not confident that it will. You can have a bloody bear market without crashing. This is a different situation this time. It's far more onerous than any other bubble situation we've ever seen. And I think the outcome is going to be different than we've ever seen before in terms of the real world consequences.
Mm-hmm. So what do you think some of those real world consequences are? Like, does that just include your thoughts on the markets, or does that include more kinetic?
Broader, much broader. Yeah. I
Conflict?
think it's not just going to be located. Well, obviously, if the U.S. has trouble because of the bubble and the economy weakened sharply, and I'm not sure recession will be the word that's used at some point, the world's not going to go up either. And, in fact, we did a study recently. You'll notice Shanghai is quite strong right now, composite. But when you look at its price versus 2009, it's like a double and a half from where it was in 2009 bear low. Whereas S&P's a 10-fold move and NASDAQ had a 19-fold move. So there's no comparison. So there are parts of the world that will suffer with us. Why? Because our economies are tied together.
Yep.
But their stock markets aren't going to implode like ours because they're simply not bubbles. And therefore, we put out a notion that a good spread idea, a market neutral, global market neutral, would be to be short the S&P, the NASDAQ, and long emerging markets. Like EEM, for example, that ETF is 30% China. And there's one bubble market within that, India, which is a bubble market. And so it could suffer badly, but it's a small percent of the emerging market ETF. So you could take $1 million short the S&P, $1 million in long EEM, and say I'm market neutral, and I bet that spread makes a lot of money. But anyway, the real world consequences, if it's as upsetting as I argue it's going to be economically, it's going to be in the street type emotions. Remember 2008 and 9. The average guy got whacked real bad, even if he wasn't involved in the stock market, because he got laid off or his wife got laid off, et cetera, et cetera. And this time around, I think there's going to be another market event that few expect. We haven't talked about T-bonds yet, and they could be a stick of dynamite factor for the stock market downside. Also, you mentioned the dollar. The dollar is, as far as we're defined it, at 104.21, the close of March, the dollar index went into a major bear. Right now we're at 98. We think it could go down to the 70 or lower. So we think it's entered a major bear market. That's a factor as well. Bitcoin's a factor. Commodities is the other factor that few expect to see it turn up sharply. Trump said drill, 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 right? Okay, so oil is quiet and suppressed at levels that most people in the industry regard as dirt cheap, by the way. In fact, some of them won't even hedge here because it's too low of a price to even hedge. The technicals of crude oil and the technicals of the Bloomberg Commodity Index, which includes energy, grains, meats, base metals, and gold and silver, is such that it looks like it's ready to erupt to the upside for another major up leg. The first major up leg coming out of the bear low, by the way, on Bloomberg was in the 50s. Right now, we're trading either side of 100. We got up to 140 back in early 2022. And when that war started, commodities peaked. They didn't go up because of the war. They peaked because of the war. And they pulled back to 100 from 140 on Bloomberg. And then went to sleep now for 2 years, either side of 100. Totally boring. Crude oil has done about the same thing. You can look at about $65 on crude and go back about 3 or 4 years and draw lines sideways. And we've been above it and we've been below it, mostly above it. But it's basically a boring situation. We argue it's basing, that Momentum argues you uptick crude oil next quarter to a 68 again, watch out. The lid's going to come off. I don't know what the reason will be. Maybe it's just a cheap asset for too long. And money's going to flow into that asset category. Commodities are cheap relative to stocks. Commodity companies are cheap. But the Bloomberg looks set to explode again too. And that would really be an emotional ambush again for the average guy. Not only is 401k going down, but when he pumps his gas, it's gone up 50% or doubled. And that wasn't supposed to happen, right? Okay, we were told that you vote for me, it's not going to happen. The technicals look like it could very well happen. And that will be an ambush factor. That'll help change the world again. Reallocating everybody's notions about what's the truth. Okay. And that's when when you get things like that happen, that ambush people this way, that way, the ways they didn't expect, that's when changes occur. Like, for instance, I bet there's no Federal Reserve in a couple of years. We go into this crisis, they're not going to solve it. There's already enough voices out there that doubt it anyway. And not just here, but other countries might reconsider too. Is this central monopoly over money really been valid and viable? Or is it just added to the boom bust cycle? Another factor, if we go into a major recession, and I think we will, stock market breaks, you will, the public's ability to pay taxes is going to collapse. And already we know that the IRS doesn't collect what it might have expected years ago to collect in terms of percentage of money that the government needs. And even Biden, 3 months, suspended taxes during the COVID crisis. Okay, remember that? It wouldn't shock me that because of its dysfunctionality, its inability to collect. And by the way, they cut its labor force by what, 25, 30% recently, the IRS? Your chance of being audited is collapsed. So the ability of the IRS to function as an income source for the government, it may be tossed out the window as well. Where in a financial emergency situation, the president declares income tax is abolished, we're going to a national sales tax. Things like that could change. Am I insisting that they will? Yeah, I'm not sure which ones will change, but likely those are the kind of events you're going to see that will surprise people, where major institutions and ideas suddenly get sidelined.
Michael, obviously we talked about the Fed cutting rates, and that only applies to the overnight rate. But you also mentioned this idea of how T-bills can affect the market, and how understanding the longer end of the yield curve also plays into the stock market.
Yeah. Now, the T-bond futures we watch are 30-year futures, have been around for decades. If you go back and look, we turned bearish on T-bonds at a price of 170. That's back in late 2020. They collapsed down into the under 100 in late 2022. No, excuse me, down toward 100. And you can draw a line sideways from October of 2022 across the price action, or if you look at a yield chart across the high levels of yields on the long-term end of government debt. And there's been no relief. What looks like a basing pattern on price, where price just refuses to go down anymore. It's had a couple rally attempts in the last 2 years, each of which has been gone up for 4 or 5 months, and then they whack it. It can't seem to get off the ground. When we do our momentum studies, we have two levels we're watching right now, because we know that, like Jamie Dimon has made this point, that this time the government debt problem might not be wished away. This time could be different. Okay, technically I agree with him, because it's made so many efforts to be an alternative place to be for assets. Back in 2000 to 2002, 1990, 2007 to 9, if you owned T-bonds, you did fairly well. Not stocks, but T-bonds went up along with gold. This time around, it's only gold been going up. T-bonds haven't risen. In fact, T-bonds are behaving. They had a crash event in early April too. Why? In other words, yield tried to go down, price went up, and within 2 days, they took T-bonds from, I think it was like 120 something to 111. Wow, 2 trading days. Okay, and where are we right now? 114, just laboring. We've got some technical numbers in the 113s, and then at 110, levels we've already seen, but if you go back there again, you could get an implosion event, meaning a sudden downside spike in price, upside spike in yields, which would upset the central bank greatly. It's not on their list. Their mandates control the bond market. They don't control it. They control T-bills, but not T-bonds. If that event occurred, that would upset a lot of sectors, debt-related sectors like commercial real estate, for example, and ambush the stock market. So that's one of those factors as well you got to watch if you're in the stock market. Quit looking at NVIDIA and Microsoft. Look instead at what are T-bonds doing. And if they get out of control on the downside, the Fed's going to go into panic mode.
One of the things that I wanted to touch back upon here, Michael, is the idea of how the market has reacted, how market participants have reacted after Powell's speech. Have they piled back into the Mag 7?
Yeah. It's party time. We've done a study on this, and if you go back and look at 2000 top, they ceased raising rates during a lot of that bull trend. And the market, we got bearish in January of 2000. The S&P dropped a couple months down into February, March, and went back up and made a new high, marginal new high. It didn't go anywhere after that. But it made a new high, even though annual momentum said you're done. Okay. It went laboriously sideways, and the Fed did nothing during that time. In January of 2001, they finally started cutting rates. And this is like the high monthly close for the S&P was August of 2000. So about 6 months after the high, S&P drifted off of that high. Wasn't really into a bear mode then. The public didn't sense that. Mm-hmm. But the Fed cut twice in January of 2001, beginning of the month, end of the month. And if you look at the action, there was a rally in the S&P. No, not back to the highs because it was already on the downside, but still a lovely little rally. Party time. Okay. They cut all the way down. The market went down the whole time. They cut rates the whole way down. It didn't work. Then go to 2007. They ceased raising rates. I think it was in 2005, and rates were flat for a good period of time. In 2007, the S&P went up to 1550 level in price, which matched the 2000 bull market peak, 1550. They got sold into the summer of 2000. During that time, Bernanke in May of that year said, there's no mortgage problem is under control. Don't worry. Okay. Confident guy.
The official rejection.
The official rejection. Lovely statement. You got to trust those guys. You know, they know what they're doing. Okay. Anyway, you made a low in the summer and went back up and took out the high. In September, you were back up near that 1500 level. The Fed cut rates by half a basis point. It was an ambush cut. Nobody expected it. There was a sharp rally for 3 more weeks, made a new all-time new high in the S&P. You took out the two 1550 price highs of 2000 and mid-2007, and you went up to 1575. Took it out, like the grand price breakout, triple top breakout, right? Okay, great. That was the top. So you had a 3-week party and an unexpected rate cut. Now we have a fully expected rate cut, and Powell's increased the odds, now instead of like 60, 70%, now it's like 90% plus we're going to have a rate cut. Okay. But it's priced in. And so, yes, you had a rally right after he spoke. Mm-hmm. It's like a 1-day event. And it's because it's probably already priced in anyway in this case. So when the Fed starts cutting rates, we call it a tombstone event. You could put a tombstone on the price chart in January 2001 or September of 2007. And if you shorted there or exited the market there, you did great. And I assume right now we've had the party. Powell said, okay, I surrender. We're going to get a rate cut. Probably be half a basis point. Who knows? But it's in the market. So it wouldn't shock me that we've had that event. In which case, even if he cuts rates, it's already been bought. So I wouldn't buy the news. It's not news, okay? And the question is that the tombstone event? Mm-hmm. Because it's been a year for no rate change, Mm-hmm. And anyway, that's what I see there. So when the Fed cuts rates, it's a signal that, something's wrong. Powell's been telling us for a year that, the economy's great. Well, why are you cutting rates then? Okay.
And revising job numbers down dramatically.
And suddenly saying, oh, man, well, this job numbers sucked anyway. You go back 6 months and go inside and look at what was the sector. Oh, home care services. Okay, that's good. It's essential, right? Okay. Bartenders, waitresses, hospitality. That's the growth. Also, state and local government was a huge component the last time around. And usually government hiring has been a huge thing for the last 6 months. And when you look at things like transportation or factory, flat to dead, if not declining. But the overall number looks great, okay? So it's all illusory stuff. And he finally admitted to it. That's great. So anyway.
So, Michael, we've talked a lot about gold and its reaction here. Do you think we should be thinking any differently about silver's reaction, despite the setup for gold with the interest rates and the equity markets that we've already touched on.
I think silver is participating with gold. It vastly outpaced gold in that 2020 rally. Silver almost doubled in price, whereas gold went up about $500, which is like 25%, 30% rally. Silver doubled. So into mid 2020, silver had outperformed gold on a percentage basis. But from 2020 through, the recent low, the silver spread went from like 1.5% of the price of gold down to 1% of the price of gold, even got below 1%. We divide an ounce into ounce and you find it was 1% of the price of gold. If you go back through 50 years of history and look at that spread relationship, you'll see that when you get down to the 1% level, it's time to buy silver. Okay, it's meaning it's dirt cheap. It's not going to go to zero versus gold. Okay. But then the technicals turned, and so over the last 4 or 5 months, you've seen silver outperform gold. Like, for example, back in April, gold hit 3,500. It's gone sideways, April, May, June, July, now, August, 4.5 months of comatose but steady sideways. They keep trying to sell it, but then go down. But it also doesn't go up. So it's had a sideways correction, which is, by the way, not the way gold ever tops. Okay. During that time, silver's gone up sharply. Okay. We assess technically that silver's now at a point where it's going to outperform gold fairly dramatically. If you go back over 50 years and look at that same spread, you'll see the number of years it got up to at least 2% of the price of gold was like 21 of those 50 years. So it's not abnormal at all. So from the recent low of 1% to 2%, meaning silver could double in relative value to gold, probably over the next year. Wouldn't be surprising me by the end of the year even. Same is true with the gold and silver miners. They're back into outperform mode versus gold. And if you'll look at gold sideways since April, look what GDX has done. Vertical. Okay. So I think those parts of the monetary complex are the place to be right now. Silver, the gold and silver miners. Gold will re-engage, and I think it's going to re-engage probably later this month or next to the upside, where people say, oh, it's awake again. Mm-hmm. But silver and the miners will be the place to be.
Well, that's exactly where I wanted to go with this is, are there particular breakouts that you're seeing within the precious metals complex that is really confirming that we're in this next stage of the precious metals bull market?
Yeah, they've already done that, frankly. Silver had a high back in October of last year at 35. It dropped. Came back up in March of this year, hit 35 again, dropped. In fact, it had a cleansing drop down to 27.50. And then came back up, and in June, it got up above 34 again. Again, not taking out the 35 plus highs. Okay, they were like 35.50 each. But at 34.90 area, we had a major momentum breakout of a structure that said, okay, silver's coming out of this congestion. By congestion, I mean, if you go back to May of last year, silver was 32.70 at a high. You could draw a line sideways through May of this year where it was either side of that level, up and down, but really just net sideways. Mm-hmm. When it got back to 34.90 in late June, we said, that's it. It's coming out of here. Whoosh, went up to 39. Now, as typical, the price chart guys like to sell round numbers or just in front of them. So let's risk 40, okay? Okay, and now we're trading either side of 39 right now on the September contract. We think the process has already begun that you were asking about. We think the acceleration phase in silver and the miners. Now, for instance, GDX has gone from a sleepy upside pattern to suddenly it's now up to near its 2011 highs. We expect GDX not to even stop until it clears its 2011 highs, meaning get up in the upper 60s. And same with the miners in general. Silver, we think in this move, in this acceleration phase for it and it relative to gold, is likely by the end of the year to see $60 to $70. Meaning those old antique highs at 50 in 1980 and 2011, which are really sort of jokes. Because one, you were up there very briefly, like days, and back down. And when you do a real valuation, the degradation of the money unit since 1980, the increase in the M2, or since 2011 even. Heck, gold would probably have to, silver would have to be $200 now to just match in real value terms those price highs we saw then. So it's catching up. And I think this surge will blow past those, what we call idiot highs. And at that point, what's going to happen? The public's going to say, oh my gosh, I missed this. I got to be in it. And so I think that's when you're going to see an onrush, fairly fresh, of money moving out of the doubting stock market into, hey, I missed this. I got to be in it. The gold, silver miners and silver. And that's when you get this gush effect. The wet bar soap effect, where everybody's grabbing it, it goes up. This is not unusual in markets anyway, but especially in these situations, I think I think we're in process right now, in other words.
So when we consider that type of move, Michael, do you see this as more of a different type of new high? As you said, this was kind of a silly joke of a high, up to $50 and instantly back down. Do you see this as a possibility of being a more sustained type of new price level for these metals?
Yeah, and both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. Mm-hmm. But that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold, because our low is $1,050. Right. So a ninefold move from 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stop it at 8,000 is highly unlikely. But even if you went to 8,000, do a tripling of silver relative gold, silver would be at $240. Is that about right? So it's the point being, when we go up there this time, also the events in the world and in the street events, the academic notions about what works, what doesn't, policy changes, institutions collapsing, they'll be institutionalized again. And it won't be a shift to cryptos, okay? Because that jolt could happen. It's going to happen. Whether we get a crash out of Bitcoin or not, we're going to get a massive downside jolt. You don't build that kind of structure, in which case you look across the horizon and you say, well, there's only one place to be. And even governments will recognize that, and they'll make the transition because public demand. So that's why I think when you get up there the next time, don't expect it to implode. Mm-hmm. Expect instead more like a new reality, a new zone.
Before possibly a new Bretton Woods type moment, right?
Yeah, whatever. But it's, the fiat currency competition, when we run the dollar index, for example, that doesn't really show you the value of the dollar. It just shows you the value of the dollar versus other pieces of paper, okay? That are doing the same thing, just not at the same rate. Or as you said, if they cut rates, that's been helping the dollar hold up a bit better than it might otherwise have been. But when you start cutting rates, then you suddenly, you put more downside pressure on it, because you have less incentive to own things in dollars and, et cetera, et cetera. So anyway, all these events are massive potential, not just fundamentally, but we see them technically. Forex, government debt markets, not just our debt market, but Japanese, et cetera. These are crisis type events. And when they unleash, the guys in charge you will find out they're not in charge. And when that reality hits people, that's when arms go up in the air. And I've said this before, Javier Milei in Argentina. I wrote a book 53 years ago called Anarcho-Capitalism. It's debated whether I came up with the term or not. Javier Milei declared himself, this is a year ago, got elected two dominant political parties, both of which were fascist socialists combined, where they controlled the economy up to here and turned what was the seventh biggest economy in the world into a third world country, virtually, Argentina. He's come back and said, let's tear it all down. Arms up in the air attitude. And the young people said, yes. They didn't understand exactly what his direction was, but they knew he just was going to get rid of the stuff. And he got rid of, for example, the control over housing in Argentina, rent controls and stuff like that, which had caused prices to be so high that the lower class folks simply couldn't afford housing. Suddenly, housing prices have collapsed to where the lower and middle class can now afford housing at a much lower price. He simply got rid of those government controls and those agencies. So it's that type of action you'll start to see here, there, and everywhere. Things just go up in the air. And assumptions you had that will continue, they don't continue. New reality dawns.
Mm-hmm. Well, there's certainly a lot to think about here, Michael. And, as you're describing this time of when people and governments just look around and wonder what is there that is, of real value, this to me speaks to a time when gold and silver become almost unobtainable, right?
Yep. And I think there's a
real gold and silver.
Yeah, real gold and silver. Yeah, no, there's no question. And I think these things won't be incremental. I think there's a point at which, the chaos theorists, and I agree with them on this, you have this incremental up or down move in a given trend, and suddenly it erupts. And you get things done very, very quickly. Mm-hmm. Not necessarily a crash, but, far more dramatic than what you are normally see. And this is why a lot of the technical metrics that people use that are free on their quote screens, like RSI and MACD, which we ignore, we call them wet noodle indicators. But, they get up to certain levels and you say, oh, it's overbought. Those are based on norms, prior norms that go back X number of months, X number of years, X number of days. And you get up to these certain oscillator levels and you say, well, that's overbought. You can go back, for example, and look at 1979 and 80 or 2010 and 11, the latter parts of those bull trends, when silver suddenly went from this arm wrestling to an explosion. You take those overbought readings, you buy them. They stay there for 4, 5, 6 months of vastly overbought. And that's when you make all your money. And yet, in other words, a norm is broken, is what I'm saying. And so you see it both technically, and I think we'll see it fundamentally.
Mm-hmm. Well, Michael, I really appreciate you walking us through how you see let's say the hidden side of the technical analysis on a lot of this stuff. There's more than just price that we need to be looking at. And of course, you're a specialist in the momentum side of things. For anybody that's wondering, all of your stuff is available at olivermsa.com. And of course, Oliver at Oliver_MSA on X as well. Is there anything you'd like to leave our listeners to think about before we wrap up?
No, just get on the right side of this stuff. Anticipate that which you don't anticipate as possible. In other words, if it fails, it could fail in a way that is dramatic. And if it succeeds, it could succeed in a way that you didn't expect. I know a lot of the gold mining investors, frankly, are stunned by what's happened the last 5 months in the gold miners. Mm-hmm. They'd given up. They were long, but they were frustrated as hell. This thing's it's sick. It's just, it slobs along and then suddenly bang, 50% increase in a matter of months. That's the way reality is going to be going forward. And a lot of these things are going to occur not in years, but in several quarters. Mm-hmm. So expect it.
Kind of like the process of going bankrupt, right? So
yeah.
Not at all. And then suddenly all at once.
Yeah, suddenly you're there. And that's why we're watching the technicals of some of these financial entities. Okay. Mm-hmm.
Excellent, Michael. Always appreciate your time. Thank you, sir.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.